What's going on, everyone? We're going to wait until some people get on, but I got to say something. I am looking back here, and I don't know if you can see this too well, but on my screen, I'm going to just point to the fact because tonight we are celebrating 50,000 awesome people. And a lot of you are watching right now or about to be watching. And look at this. So a year ago, we were sitting at like 15,000 subscribers. If you can see that, I don't know if it zoomed in too well, but 15,000 back in September. In fact, tomorrow, September 10th, will be exactly a year, 15,000. Look at this upward growth. And I have nothing but absolute gratitude for every single one of you guys out there for being part of this awesome, awesome community. Thank you so much. We got a lot to talk about tonight. I actually have a ton of different comments that came through, and I'll share that a little bit later on. Right. So we're going to talk about that. We're going to go through your comments that you gave me on the community post. And also, if you have any drinks, drink responsibly. But if you are drinking tonight to celebrate, I'm going to get in the fall mode. And this is Rogue Pumpkin Patch Ale. In fact, I just found this. And I don't know if you've ever heard of Rogue Dead Guy. This is very similar, same brewing company. I think they're based out of Oregon is what I found on the back of this, but I am going to give this a whirl, kind of kick off fall a little bit early because we all need some fall in our life after, I think, a very long, hectic summer. So I'm going to pour myself here. We're going to wait for a few more people to join us. And then I'm going to kick off with the first question. If you have questions, guys, drop them in the live chat anytime. We'll try to get to as many as we can. If I can't, I will look back over at the end of this stream tonight, and cheers to you, by the way, and I will dedicate future videos to any good quality questions that might be I think good for a future video that'll help a lot of people out. So I saw a thing today that I'm like, man, this is so true, and I know a lot of you guys are following this, but let me pull this up so I can actually make sense out of this. This is a quote that I found that somebody shared with me. I'll look on my phone here and pull it up. So it basically says here, make $70,000 a year. So let's say you make $70,000 a year, but you're spending $69,500 in expenses. That is what is keeping people broke. That's what's keeping people poor. Obviously, you only basically have $500 of, I guess, what I'll call profit. And the rest of it is getting blown on, maybe it's, loans, maybe it's, debt, maybe it's just going out and partying and things like that, which is fine. But you're only giving yourself $500 a year to maybe invest or to profit off of. But somebody that's making less than $70,000 a year, let's say you're only making $45,000 a year, but you're only spending $30,000 a year. They're actually richer. And I'm like, yeah, that actually makes a lot of sense. Wealth is created by increasing the gap between what you make and what you spend. It's not how much you make, it's how much you spend, which is so true, and how much you keep. So that person's only making $45,000 a year, but they're putting away that investment type, man, they're going to be so much more richer in the future. And if you look at it, and honestly, this has been proven time and time and time again, that those people end up enjoying, and I'm not talking 65 years old guys, I'm talking about people that start early enough that are really hustling significantly. They take off like so much more in the future than somebody that is blowing all their money now. So seriously, if you can find a way, and step one, find a way to reduce some of those expenses so you can start investing the heck out of that stuff so you can be a future millionaire yourself. And then obviously there's a ceiling on that. You can only cut expenses so much. I guess I should say there's a floor, not a ceiling, because you cut, and you don't want to live in a cardboard box or anything like that. You don't want to, cut yourself so low that you can't even live a life in the present. But there's a floor to that, right? So once you cut your expenses, but you're still living okay, then it's time to find, how do I increase my income? That's going to your employer, finding a way to be more valuable to that employer. So hopefully they can give you a raise or a promotion. Or if that's not working out, do some side hustles, get a second job, do something like YouTube, do something that scales that up. And then you take all that profit, you throw it into the investments, you throw it into something worthwhile, you expand into real estate or a business, I don't know, something like that, whatever. You scale up, and that's the key. So, all right, let's see here. I'm looking through these comments. I will try to get to as much as I can. Let's see here. Pay yourself first. The richest man in Babylon. Hey, I have that somewhere. Yes, I have that back here, guys. This book is great. Pay yourself first. This was recommended to me a long time ago, back in the day before I discovered Audible and audiobooks. I'm not I read, but I'm not the I'm not the biggest fan of just reading a book, but I did read this. But I bet today I would totally get this on audiobook, as long as the voiceover is at least energetic enough to keep me awake. But phenomenal book, regardless of all that. That is a great way just to kind of start with the basics of finance, and it's from way back all the way to today. A lot of people have been helped by that. I think it was written a long time ago, wasn't it? Like early 1900s or something. Like it was a long time ago that this book was written. And here in today, it still shows a lot of success. I can't see it right here on the first couple pages when this was originally written, but I swear it was like, 1926 is what this says. So check this one out wherever you want to buy your favorite books from. I don't know, like Amazon or Audible or whatever. Really a good one. So let's see here. Hey, Dave, thank you so much. Enjoy that work. Make those dollars, and thank you so much. I appreciate your support. Yes, you can call me Bobby anytime you want. Some of my family still calls me that. So there you go. And we're family here on the, on it all. Oh, I got to answer this question before we hop to some of the pre-selected questions that I have. Herbert asked, any regret after all? Now, I don't know what you're asking exactly. Like any regret in finances or in like anything like that? Or are you talking about YouTube? But I will say I'll answer that question from the standpoint of finance, anything I did. And I'll tell you what, we moved down here. We're in Florida now. And we moved down here right at the height of the housing bubble back in 2007-ish. And I was just so gung-ho on getting a house back then. Didn't want to get an apartment, didn't want to take, the slow, easy route. I just wanted to go all in, get a house, make it happen. And the housing values, especially in Florida, were at an all-time high. They were absolutely insane. So we went all in, we got the dang thing. And that is my biggest financial regret. And I'll tell you what. I think in my mind, and remember, this is like a long time ago. We're talking 2007, long time ago. Not as skilled and knowledgeable as I am today. And, we have all made those mistakes where we're like, dang it. And this is one of those mistakes that have, I think, helped me a lot in shaping my financial future here today, is that I went in, got that house. It was a very small house, but it was all we could afford. Then the housing freaking crash happened, 2008, and that thing went all the way down that we were so underwater. If we would try to sell it, we would have owed about $180,000 just to sell it to somebody else. That's absurd. That's stupid, right? So of course you have the option. You could foreclose, you could short sell. We didn't do any of that. We just hung on to the dang thing, and we hung on and hung on. And we did not sell that until 2020, right before the pandemic. So February 2020. So I had to, in my mind, I wanted to get out of that in 5 years. I thought, okay, we're going to move into this. This will be a starter home. We'll last about 5 years. We'll sell it for a profit, and we'll get a bigger house. Well, I had to wait and wait and wait through all the pain and agony of all that. And granted, we never know when a market is going to dip or correct, either in real estate or in the stock market. But I think my rushed nature was my biggest regret. Not actually taking the time to say, let me think this through. Let me do some research. Maybe let's move to Florida first before we just start looking in Florida from a state far, far away. Really dumb stuff. So that would be my biggest regret. I will say that we finally did sell it for a profit above what we originally paid for it. But to me, I mean, look at the time on that. You had to wait from 2007 all the way up to 2020 to finally make a bloody profit on it. Killed me. So cheers to all you guys. I got this Rogue, if you just joined us, Rogue Pumpkin Ale. This thing's awesome. I found this yesterday, tried it out yesterday, and I'm like, this is my jam right now. This is a fall time, it's fall in a cup. So, cheers to all of you guys. All right, so first I'm going to get to some of these pre-questions. Let's share this so you guys can see exactly, and shout out to all of you who, I hope I can do this right. Let's see if this actually freaking works or not. I'm going to try to share. You know what? I'll just share my whole screen and then we'll get to it. Okay. It's going to look weird for a second. Here you go. All right. So I'm going to do this on PowerPoint because whatever. So, okay. Here's my first question. Can you explain more in depth about the stock lending program? Is it good or is it bad? Okay. Let me just make sure can you guys see this? I'm going to have my little comments. So you're going to see, I think, your comments on the screen, but whatever. That's cool. Just want to make sure you guys can see my screen. If not, start screaming in the chat so I can make sure that I'm not just talking to nothing. But it talks about explaining more in depth about the stock lending program. So what this is in Webull, okay? So Webull has this stock lending program where certain stocks, not everything, but certain stocks, they'll actually lend that out. So they actually have it here. I don't know if you guys can see that too well. Let me zoom in as far as I can here. So basically, you still own the stocks, right? You still own your stocks that you buy within the Webull app, okay? They then will take that and lend it out, and you basically earn interest on that. So you still own the stocks. This is just a little program that they do. If you think about it, that's how a bank works in a savings account. That's why I hate savings accounts sometimes. You put your money into a savings account at whatever bank you want to choose. Maybe they pay you, I don't know, what is it, 0.04% in interest. And all the while, they take that, and a lot of banks invest that money. So they're already kind of lending your money out. Now, of course, they have the backing in order to provide that money to you if you decide to withdraw money out of your savings account. But kind of a similar scenario where they'll lend their stocks. And then you can see, and this is coming directly from their app, by the way, if you're wondering where all this information is coming from. But extra income, collateralized, that's basically what I just mentioned, no restrictions, easy and automated. And depending on what you have, depending on what kind of stocks you have, it can be kind of cool. Here's a good example from me. So I just recently invested in a few stocks. If you look up here, it says $2.87. That's owed to me, I think, in this next month. And it's a lot less than what recently is going on, because I started scaling up on one particular equity. And look at this, 817, 25 cents, 818, 40 cents, 819, 44 cents. I think whenever this gets added up and paid out, obviously that's way more than $2.87. So something in my account, which I think is my recent purchase, is being lended out in the stock lending program. Whatever. I mean, I'll be honest with you. I may have clicked on the fact that I have this. Like I don't know if I can't remember if Webull asks you on your application if you want to be part of this stock lending program or not. So I may have just said yes, or maybe they don't. And they just kind of do this for you. I don't know. It just started happening, and here's some good examples of how it works. I think it's a fine program. I mean, there's nothing wrong with getting some interest. It's a couple dollar bills. It is what it is. It's not gonna make you rich, but hey, money's money. I'll call it a win. All right, so hopefully that answered that question. Thank you for that awesome question on Webull. They are still offering 2 free stocks. If you haven't signed up, you can go check that out for yourself. Link in the description. Here's another one. All right, looking for dividend payouts of NTF, and I think you mean ETF, exchange traded funds. And where's the best place to find the trending ones? What is a good resource on the side of using apps? Okay, so let me open up a new window here, and I'm going to show you exactly. You go to etfdb.com, and here's what I would recommend you do. Now, I'm going to add a bunch of things to this, I guess. What I mean is like disclaimers to this. But if you go to etfdb.com, first step you want to do is click on this ETF screener, okay? And click on that. And then what they allow you to do, and what's really cool about this website, it's free, minus the silly ads that keep popping up. It's free to use unless you want to upgrade for some additional features. But you can look through and decide from an ETF perspective, exchange traded fund, what do you want to invest in? Are you interested in real estate type of ETFs, commodities, bonds, whatever? You can go through and check all that stuff out. Now, for your question, you're asking about dividends, right? So for dividends, I'm going to click right here where it says expenses and dividend. Let me make sure you guys are seeing this okay. And I'm not, it's kind of weird because I got like, just making sure we got everything going on. Okay, cool. Just want to check my comments. It's weird that I got to share this entire screen. I can't see what's going on. So anyway, you want to click on expenses and dividends down here because that's what you're after. You want to find the ETFs that pay the best dividend yield. Okay, so here it has anywhere from 0 to 23% dividend yield. You can scroll this up. Now watch what happens to all this in the middle here. Okay, all this in the middle. Watch what happens as I move this up. It'll start. See how it started moving around? It's starting to filter out based on what I'm telling it to do. So these are ETFs that pay at least 3.92% up to 23%. If you want to go crazy, you can go crazy and go up here to like 10. And there's our typical QYLDs and things like that. Just did a video, in fact, on QYLD that you can check out on the channel if you haven't already. That's a whole different type of ETF because it's covered calls. But I will tell you one thing. Here's my disclaimer. Disclaimer number 1 is I would recommend, and I have a video on the channel, go search for it, the 5 smart steps on analyzing an ETF. The one thing you got to be careful about, especially if you're younger, when you're younger, you want to aim to grow your portfolio to millions. Once you get older and you're kind of living off of I would say predictable income, then you want to lean toward those heavy hitter dividends that are stable and that have companies that are stable in them. So don't get too jacked up only on the dividend yield. Go check out the video on the 5 smart steps to analyze an ETF. And then as you go through this, let's say you're going through, you're looking at QYLD, you're looking at AMOM, you're looking at all these different ones, or you scale this back down here to, let's say, 2.59% dividend yield. You can go through all this and then you can decide, okay, let me do an analysis on VNQ. And then you apply the 5 smart steps that I share in that video against that right there. And then you ensure that, hey, do I feel good with this? Does it meet what your risk tolerance is? Does it meet what you're looking for when it comes down to this ETF thing? So hopefully that answered your question, but that would be what I recommend, a great way to just kind of screen through what you're looking for in an ETF, but then do some additional research. Super important to do that so you don't find yourself in something that you don't want to do. All right, I'm going to stop sharing for a second so I can actually come back here and see what we got going on in our world of the comments. Isn't that how stocks get shorted? Are you talking about for the ETF or something else? I would say that, if you're talking about QYLD, they do that whole covered call thing. So it's basically they go out, they do some options trading from a covered call perspective, and then any premium that they find or that they get based on their covered call option strategy, they will then take that and they'll pay that out to everyone in the form of a distribution. So it's not really a dividend paying stock from the standpoint of a company, but it is an interesting way to make some extra income. So that's that. Anyway, sorry that you didn't get the alert, man. I didn't get the alert and I scheduled it. I'm so sorry. It was weird. I was expecting it to show up on my main channel. Usually it says like coming soon, and it wasn't doing that. And I'm like, YouTube, what are you doing to me, man? And I could not figure out why they were not broadcasting it out. So I apologize for that. But either way, we're here, we're rocking it. And I appreciate you being on today. Let's see what we got here going on in the other comments. One thing I do want to say though is, again, thank you guys so much, and cheers to you for everything you guys have been, just the support. My goal here with this entire thing is to help people erase the crap that a lot of us deal with when it comes down to personal finance. We go through this thing of being caught in a hamster wheel, and before we know it, we're like 60 years old or something like that, and we're in deep trouble and we don't know what to do. I was actually just hearing a story today where someone is over the age of 70 or just around there. Unfortunately, was not doing any investments or any type of retirement planning, anything like that. And Social Security is not paying that well based on how much income they made over their life. So they're kind of stuck. And it's kind of like, okay, well, what do you do at that point? If you're over the age of 70, you didn't do any proper planning. Now, what do? You're stuck with hoping that Social Security pays enough. If it doesn't, guess what you're doing? You're working until you're dead. And that just disappoints me. And I think we can do better as, all around the globe, not just Social Security with the United States, but all around the globe. If we just apply some basic principles to finance that actually make sense, we can be so much further ahead. And there's so many times that I went through high school, guys, I went through college, I went through all the BS. I even got my master's degree. So talk about student loan debt, it's ridiculous. But if we would have just learned how to do personal finance in high school, college, I don't care where, just better ways to manage our money, we wouldn't be sitting here like, what the heck is going on? Why do I not have enough money at the end of the month? And I'll never forget my early days when I was first starting out, like back in 07, when I bought that stupid house. And we didn't have enough money. Like we had student loan debt, we had car debt, we had credit card debt, we had house debt, we had all this crap. And it's like, how do I get away from that? And so my goal is to, through all the failures that I've kind of learned through my life, not that I'm old, I'm just saying in the last even 15 years, I've learned so much that I wish I learned in high school. And now I want to make this YouTube channel and help as many people as possible break the cycle of crap so we can become better with what we do. And honestly, another thing I want to do soon, guys, I'm trying to figure out how to do this. And maybe if one of you guys know how to do this, I would so appreciate a heads up. Even if, I don't care if it's in the live chat tonight or later on, if you want to reach out to me, is there a way? What I'd love to do is feature you guys, if you're interested in it, on like a phone call thing. Now, I know we got Dave Ramsey and things like that, but I have a little bit of a different approach from Dave Ramsey, okay? A little bit of a different thought process behind finance, which is fine, right? We all have different ways of doing things, but I'd love to feature, just like he does, a phone call type of thing. And it doesn't have to be live, but like, let's say you dial in and you ask a question that you want me to answer, and I feature it live on an upcoming YouTube video, and I answer it right there on that video. So I need a way, I've been looking at different phone numbers and different outlets to use, but I think my issue with that is obviously there's a lot of spammers out there, there's scam people, and I don't want to deal with all that crap. So something that's legitimate that can provide you safety too, that you can call in, leave your question, and then like hopefully it'd be kind of cool to hear your voice and hear me answer your question, whatever that may be. And then maybe someday we scale up and we actually do live conversations on air. We'll figure that out. But that's kind of what I want to do in the future. So that is kind of the, oh, I'm scared you'll hear the struggle. Trust me, I was actually kind of freaking out before this live. So don't worry, we're in good company here, so that's the whole deal. We'll just deal with it. You got this. It'll be okay. It'll be okay. I promise. If I can do it, you can do it, but yeah, anyway, so I got to be transparent. I mentioned Dave Ramsey, right? So I'll tell you something. I grew up on him when I started getting into the game, right? So again, going back, 07, bought the stupid house, way too much money, was in debt. And then I found him, right? I found this whole thing about total money makeover and all that. In fact, one of his books is back here, in fact. And so I did that. I did that whole process, baby step 2, 3, 4, 5. We're now on baby step 6, if we're still following that correctly, which is paying off the house. But my issue is there are some things I don't agree with that I think that, and I'll tell you right from the start what I don't agree with. First of all, he tells you to live on beans and rice, which I agree with, but I don't agree with the fact that you should just totally stop contributing to your 401k. I don't like that idea. So if you have an employer sponsored account and they're basically saying, if you put in 5% into your 401k, we're going to match you dollar for dollar up to 5%. Well, Dave Ramsey saying, no, hold off on that. Just put every dollar you have toward debt. That's giving up extra money. And that bothers me a little bit. And I listened to him during baby step 2 when we were going through it. And I wish I didn't, because I look back on what my 401k value could have been, even with just a measly 5% going into that account over that period of time, because sometimes it takes a long time to get out of debt. It kills me. And at the same time, it's like again, I've said this on my videos, your employer is like, hey, we want to give you a raise. We want to give you this extra money. All we require is that you put this money into a 401k. And you're saying, no, I'd rather, no, I don't need it. I'm not going to do that. It's like, when would you say no to an employer trying to give you extra money? I mean, we always want extra money, right? So that's one thing I disagree with. And also credit card usage. A lot of people, some of you have heard this before. Some of you like it. Some of you hate it. But I think using your credit cards wisely with responsibility and treating it just like cash. And there's a way to do it. And I've been doing it now over 5 years. And I promise you, I'd be transparent if I did, but I've never had any fees, have never had any late fees, anything crappy like that. I pay the thing off with a foolproof plan every single time. And in the meantime, we get a bunch of cashback rewards and travel benefits and things like that. So anyway, so what I want to do is kind of have that new age, right? That new edge on the Dave Ramsey, right? That's what I want to do here on the channel. So that's kind of what the game plan is. Let's see here. I'm going to read through the comments, make sure I'm not, what's going on here? Okay. 3 down days in the S&P. Yeah, the S&P, and I got to say something here about the S&P going down and just the stock market in general. Look, if we see this, I have this thing, and I'm not financial advice. I'm not a psychic. Nobody is, whether they tell you they're trying to figure this out or not. But the thing is, we've been having a lot of uptrend. I mean, this year has been phenomenal for the stock market. I mean, go look at the graph and you'll see it. Anytime that happens, when you have that big spike, you're always going to have a correction. Look back over time, it's always going to happen. You're going to have a correction and it's going to go down and people are going to freak out and they may sell. And I don't recommend you necessarily sell, especially if you're going to lose money. Just ride that roller coaster down. Hopefully it doesn't go too far down, but it might go down a little bit, right? You're going to have those typical corrections in the stock market and then build that back up. And that's kind of the key. And then if you have extra cash, especially if you work on getting out of debt and you start these side hustles to get some extra income coming in, when that market does dip and you have those down days, that's where you have some cash sitting around and you just start slamming it in, man. You buy the dips, because if you buy the dips, then you have that opportunity to really ride that market back up. And trust me, it's an exciting feeling when that happens. Not cool to see it go down, not cool to see it go down, but it's cool to see it go back up. Somebody asked me earlier about the cryptocurrency, and somebody also asked me Oh, and then, oh, okay, Cardano. Yeah, I have some of that, ADA. Crypto's getting interesting. I have a article. This is getting weird. I'm going to share this with you guys. Let me see if I can pull this up. Give me 1 second just to get this pushed over to my Mac, and I will share it live here on the video because I think this is something you guys should look at. And again, some of this tends to be BS, right? So I'm just going to tell you, we don't know, but let's share this here. Hold on. I'm going to go here, share the screen, and you can check this out with me. There we go. So it's talking about Coinbase, right here. Let me get rid. Oh, don't have a paywall. Okay, good. SEC warning to Coinbase is part of a worrisome trend for crypto. So what they're saying here is that obviously Coinbase is now a publicly traded company. It went down a little bit, but basically what they're saying is it would sue the crypto exchange company if it went ahead with a plan to allow users to earn interest by lending crypto assets. That's interesting, isn't it? So all of a sudden the SEC wakes up, or maybe they have been awake, but they decided to put this on to Coinbase saying, hey, you're going to have some issues if you decide to do that interest lending program. I think a few other companies that are not public have this. Remind me in the live chat. I think in Gemini and a few others, some of those other crypto places have the ability to earn interest. Well, this one, because I think that they're public, maybe they can get a little bit more pushover from the SEC, which stinks. But look at this. I mean, SEC and other regulators seem concerned about crypto companies offering high interest rates for people lending out their assets, a service traditionally performed by banks. So the thing I got to worry about a little bit here, and again, it's all a bunch of fluffy stuff. You got to keep your eye on it and just make your own best decisions. But could this be a sign of future times where you have the government stepping into things that really is technically unregulated, deregulated, decentralized, which is the cryptocurrency world? It's going to be interesting. So again, I'm not saying that, you need to run in fear. It's just keep your eye on this kind of stuff. This just popped up. Look, September 8th, got this notification from somebody yesterday, 11:02 a.m. So, I just kind of interesting that they're doing this. What do you guys think about that? I mean, I think that anytime the government gets their hands on something, it can be a little bit weird. So anyway, again, thank you for those congratulations. I appreciate it. Oh, Primal saying you can be better than him. He's talking about Dave Ramsey. Thank you. I appreciate that. I really want to, it's a new age, right? It's all about that new age. No foul play to Dave. I mean, he helped me out a lot in my early days, but it's time for a new age. It's a new age of personal finance, millionaire making, and everything in between. All right, what are we saying here? Let's do Instagram Live instead of phone calls. You take video calls with people and give us 10 to 15 minutes, if not less. Oh, okay. Let me write that down. I like that. Very good. Yeah, that's a cool way to do it. And then maybe we can do like a reel here on YouTube with some extra stuff, right? So good. I love it. Oh, I love the name. FI Journey, financial independence. And that actually reminds me, that's another big piece that I want to focus on when it comes down to this whole idea about personal finance and building and the whole new age of Dave Ramsey here on this channel is I don't think he talks enough about financial independence. And I really don't think he likes it. I don't think he likes it because it's more about just build wealth and give after you pay off your mortgage. Well, what the heck's that mean? Like there's no true guidance for that. And there are a lot of people. And there are some YouTubers. Check out Our Rich Journey. If you don't know about that channel, you may. If you watch mine, you may know about them. But they retired at the age of 39. They live wherever the heck they want to, Portugal, California, wherever they want to go. And it was a lot of sacrifice to really focus on those investments, right? Grow that investment portfolio. And the theory behind financial independence is that you have that 4% rule, where if stocks average a range of about 8 to 10% average growth over the time, that you have a safe withdrawal rate of about 4%. And what you do is you look at your monthly expenses, and I'll do a video on this a little bit later, but you look at your monthly expenses, okay? And you multiply those monthly expenses, I think by the year and then by 25. That gives you what your account balance needs to be. It will be in the millions typically, depending on how much you want out of your expenses month by month. But the beauty of that is you invest that and you live off your investments. You don't have to rely on a job. you can live freely. It's financial independence. Anyway, so yes, it's good stuff. So let me see. I got one. Yeah, Aman and Christina. They are awesome. I mean, Our Rich Journey, go check them out. They got like hundreds of thousands of subscribers. They're killing it. And it's just so inspiring to see somebody. He actually did a poem about a month ago. And in that poem, it's inspiring. He talks about like, I took back 40 hours. And it was just so inspiring. Just go check it out. I think it's titled something about poem. So if you go to the channel, go check out poem, and there it'll be. And if you're anything like me, you'll be super inspired by that. So let's go back to another question that I have here pre-prep, because I want to make sure I get through these as well. And this one's going to be interesting because we are going to do something I have never done before when it comes down to right here on this live stream. So here we go. Pop it up here. Congratulations, I just recently became one of your subscribers. Thank you, and welcome to the family. After watching one of your videos, great, awesome. As for my question, okay, is it possible you could analyze NHTC, Natural Health Trends Corporation stock, just like you analyze QYLD? Okay, so I'm gonna pull up I have my little cheat sheet here. Now, I have a video on the 10 smart steps when it comes down to individual stocks, okay? This, I think, is an individual stock because it's a corporation. It's not an ETF. QYLD is an ETF. So I'm not going to, ETF's a little bit different than a stock, but we're going to go through right now. I'm going to take you through my process for looking at a company. I have not researched this one. So this is going to be fun. You're going to see my reactions here on the live, how I actually do this. Okay. So you're going to see exactly how I go through this unscripted. I don't know what this is, and I don't know what I'm about to see with this particular stock. So NHTC, let's go check it out. All right, I'm gonna pull up what I'm gonna actually do. I'm gonna do seekingalpha.com, and I'm actually gonna pull up finance.yahoo.com, and we're gonna do a stock analysis live here on the live stream. So if you're excited about that, get ready, because here we go. So what I do is I look through these 10 smart steps. I'll talk about them really quick as we go through here. We'll take a quick look at this, and I'll kind of let you know if it's a red, a yellow, or a green light. This is not financial advice at all. And if everything turns out green or if it looks really good, does not mean I'm saying go out and invest in this company. Again, I don't know this stock. This is new to me, but we'll check it out. We'll see what it's all about. But again, this is just the process. It's about how do I apply this process if you're interested in a stock? If you hear somebody saying, hey, there's this company that I think is super hot, you got to check them out. What you can do is then take that and apply these 10 smart steps to say, okay, but is it actually a sustainable company, or is it just a hot trend at the moment? And that is really important, because you don't want to put all your money in thinking it's like a long-term growth trend and it's only like a hot stock in the moment, and then it ends up like crapping out on you and it just sits around for the rest of forever. Good example of that is Circuit City. If anybody remembers Circuit City, ticker symbol CC does not exist anymore. I invested it. That's another stupid regret I have. I got a drink for this. Hold on. Circuit City. All right. They were obviously, they're out of business, but during the period of time that they were going downhill, I decided, hey, people still want to buy TVs and they still want to buy computers. I'm going to go ahead and invest in them because I think they're going to go back up. Well, guess what happens? Amazon and all the online places come around and make Circuit City kind of pointless. And honestly, I think they're making Best Buy kind of pointless too. You can buy it online and get it shipped to your house, sometimes in the same bloody day, right? Like they'll come right to your house with Amazon Prime. And I wasn't paying attention to their financials. I was not paying attention to their earnings per share. I just invested thinking, hey, maybe it'll go back up. It fell down. It's like, I think $9 a share right now. Let me buy it and see what happens. Stupid idea. It ended up going out of business. And now I finally got rid of it. I talked to Schwab and I said, just get rid of these damn shares of stock I have. And it was like, what was it? It was OTC, Pink Sheets. It's basically a junk stock that sits in your brokerage account. And it was driving me up a wall because I had all this other great stuff. And then Circuit City just sitting there. I was like, get rid of it. So I reached out to them. I'm like, Schwab, pull it out. I hate it. And they finally did. So anyway, it's really important to make sure that you're looking behind the scenes, under the hood of the car. You don't want to buy a new sexy car realizing that the engine is a piece of garbage. And even though it looks sexy, you're stuck on the side of the road with steam rolling out of this bloody car because it didn't work, right? It's not working on the inside. And that's why, doing the right type of stock research is so important. So let's pull this up. I'm going to take you right through it. We're going to see what happens. What's cool is, when you guys watch me do this on my YouTube, videos. Honestly, it's me going through this process, and it's scripted in a sense of, I have a chance to think about the company, but this has got honestly, this is a lot better because this is me actually giving you the opportunity to see how it goes in a live format. So here we go. This ticker symbol, NHTC. There it is, Natural Health Trends Corporation. First smart step. What we want to do is we want to look at dividends if you're interested in dividends. If it's not a dividend paying company, you don't have to worry about it. So we want to make sure that the dividends actually pay out more than is earned. So really, it's just coming over here to this tab here on seekingalpha.com. That's what I use because it's free, and that's pretty awesome. Okay, and actually this was part of the question. Do you think that the dividend yield is sustainable here? So it's 11.85%, which is pretty darn high. I mean, the average is around 2, 3, 4% on dividend yield. So we're looking at 11.85%. So here, let's do a calculation. I'm going to pull up my calculator here. So we got 11.85%. Bear with me here. This is all the stuff I cut out of the video, so you don't have to sit and watch me fumbling around with my calculator. But now you're seeing it. You're seeing what happens here. So actually, no, the payout ratio is right here. I don't even have to do a calculation. It's right there on Seeking Alpha, 490.91%. So that is absurd because remember, guys, when it comes down to this smart step number one, we're looking for a payout ratio that is less than 100%. If it's over 100%, the long-term sustainability of the dividend and the stock itself could potentially be in question. It could be a little bit concerning. So that is extremely high. As I said in my notes before, anything over 100% is something that I get a little bit nervous about. I thought I had to do the typical calculation. Typically what you do for that calculation is you take your annual dividend, you divide it by your earnings per share, and that gives you that payout ratio percentage. But Seeking Alpha is saving me a step by putting it right there. That's really high. That is a red light. Okay, so we got a red light going on for smart step number one on this particular stock that we're checking out tonight. Second one is the PE ratio, price to earnings ratio, one small step of the pie here. So PE ratio at 48.01%, says it right there on the right-hand side of Seeking Alpha. Historical PE ratios that I look for are right around 15 to 16 on PE. If you look for things less than 20, that could indicate if the company has room to grow or if it could potentially be overvalued. Another thing I like to do, if you want to just cut to the chase, I don't know if it won't hop over to Yahoo Finance, but if you go over to Yahoo Finance and you type in this ticker symbol, it'll say right on I think it's on the left-hand side, it'll let you know if it's under or overvalued, but that is a potential concern as well. So technically that's a red light. I mean, you could say it's a yellow, just be cautious of that, but that's pretty high. All right, third smart step is EPS versus analyst ratings. We want to see how the earnings per share are going against the analyst targets. So that's actually just scrolling down here on the main screen here on Seeking Alpha. Let's find it. Maybe I went too far. Hold on. Where's my earnings per share at? I've got revenue, which is fine. Earnings per share. Dividend growth. It's not showing me the little graph that it usually shows me. Okay, so I'm going to have to scroll up here. We're going to go into financials. I'm going to see what's going on with this company. Something's getting weird. Okay, here's basics. Okay. Earnings per share. Now, we don't have our analyst. So typically on Seeking Alpha, I scroll to the bottom and it shows me what the analyst ratings are in a blue bar, and then it shows you the actual earnings per share in a black bar. And your goal is, of course, to either have them equal the analyst ratings or exceed them. You want a growing company. So look at this basic earnings per share here. Of course, I don't pay for all this extra data, but look, 484, 210, 275, negative 52, and then 8 cents, and then trillion is 16 cents. So this is going down. That indicates a red light as well, because you want to make sure that your earnings per share are going up. So that's not looking good either. This one's not looking too hot so far. The news. All right. The news is something you take with a grain of salt. I'm not going to waste time here on the live to go through that. But one thing you want to do is look at what's actually going on with this company. So there's something going on where you're looking at earnings per share, might look a little bit weird. Maybe the dividend ratio looks a little bit strange. And you want to know a little bit more about what's going on. Well, all you have to do is look at the news to see if something's causing this, right? Of course, obviously in March 2020, you could blame a lot of things on the pandemic with a lot of these different companies and their revenues dropping. You could easily say that, hey, that's why that happened. But here we are, and we need to understand why this is happening. And if you feel good about the news, and that is obviously smart step number 4, you feel good about the news and there's a good reason why this is happening, and you think there'll be a decent bounce back, that might be something that you could consider. So again, for the sake of time, I'm not going to jump through all that. 5th smart step is revenue growth. We want to see over a period of time, any company, we want them to see revenues continue to grow. We don't want them to go backwards. We don't want them to be a circuit city. So right here it is, financials. Right here in the financials tab is Seeking Alpha. Click on the income statement. And then right here it says total revenues. So you can see it's 287, 197, 191, 77, 62. This is going down. That's not what we want. And if you look at profit is also going down, 232 down to 45. That is a red light. Hate to say it, but this thing is striking out. So I'm sorry for your question here. I don't know if you were looking to see if this is a good one, but if you put it against the 10 smart steps, we're already 5 in and it's already failed. So I'm going to go through the rest of these. I don't think I'll continue on with this because it's already looking kind of scary. But the 6th smart step is profit margin. You want to see something over 10%. Higher profit margin equals better. That means that they have a good management on their revenues minus out their operating expenses. So anything over 10% is great, higher the better. So you take the net income of the company, which you can find here on these financial sheets, and then you divide that by their total revenue, which is right here. So you could take like the last year, for example, in 2020, or if you were worried about the pandemic, you can back that up maybe to 2019. But what you want to do is take the net income, divide it by that number, and that will equal your profit margin percentage. 7th smart step is assets versus liabilities. Under financials, you go to the balance sheet. And what you want to make sure of is that if they liquidate, do they have enough money to maintain? Like, are they in too much debt, in other words? I look at total current assets. It's a good way to look at it. And that's what their current assets are as of December 2020. And then you scroll down here, or you could look at total assets. Either current assets or total assets, doesn't really matter. But make sure you marry that up with either total current liabilities or total liabilities. So look at this, for example, I'll just do a quick hit here, 99, and that's on total current assets, 99, total current liabilities, 21. So that actually looks pretty good. Total assets here, 105, total liabilities, 38. So that actually would be okay. That would be a green light because they have more assets than they do liabilities. So that's great. 8th smart step, ownership potential. What you want to do is you want to look at your number of shares outstanding. And that goes for pretty much anything, right? People love the rarity ordeal. Rarity being, the more rare something is, the more valuable it can be. So for example, in cryptocurrency, people like the idea of Bitcoin because it has a limited amount of coins available. So that's good. So the more you own of the company, the more rare the shares are, the better in a sense. So you look here at total common shares outstanding, you want to see that go down because that could mean a couple things. One of the biggest ones could be that the company is buying back shares, and that's what you kind of want to have happen. They're reinvesting into that. So look, 11.2, 11.3, 3, 10.5, 10.9. So you do see a little bit of a dip down here. That's good. So where you would typically own maybe 5% of a company based on how many shares are outstanding versus how much you own, let's say you don't buy any more shares, but they reduce the total amount of shares outstanding. Well, now your 5% could become 10%, which means you own more of the company. And typically that means that stock price is going to go up. You're going to make a little bit more money. So that's a good thing. 9th smart step is free cash flow. And what we want to do is we want to look at the cash from operations, and you want to minus out the capital expenditures. Again, you can find that all here in Seeking Alpha between the cash flow statement right here, as well as the income statement. And free cash flow is good because that means they can use things for dividends if they pay dividends, share buybacks, which is what we just talked about. And they can also use that for future acquisitions or future ongoing growth of the company. So that's always a super important thing. And then the last smart step, which is 10, is their price to free cash flow. So what you want to do is you come over to the summary and you look at their market cap. which is located right here. Market cap is 77.88 million. And then you divide that by that total free cash flow amount, which is located under financials, under the cash flow statement. And then lower numbers are better because that means that the company could be potentially undervalued and could be an opportunity for you to take advantage of. And higher number could mean that, maybe they have some overvaluing situations going on within their stock. So that's really the long and short of it. Hope I didn't rain on your parade there with that one, but that one does seem a little bit, based on the 5 that we actually truly analyzed. I don't know. that one hurt a little bit. So anyway, that's what's going on here. Let's see what we got going on here. I missed a lot of comments. So here we go. 41 people watching live and only 18 thumbs up. Hey, thank you. I appreciate the love. Thank you so much. Definitely. Hey, I forgot to say it. Don't be dumb. Tap the thumb on this video. Guys, I was thinking of making a shirt and not only make the shirt, but also maybe give it out as some gifts, to some of you guys, right? And the shirt would seriously say, don't be dumb. Tap the thumb. If you guys like that idea, tap the thumb. All right, here we go. Since you want to help people avoid financial mistakes, would you ever talk about MLMs since they tend to pose a passive income stream? Ooh. All right. So if you guys want, if you go back on this channel and you look on my early videos, you're going to see a lot of fitness videos. I actually pivoted this channel away from that. It used to be a fitness channel. And I would actually love if there's any of you watching right now that have been subscribed during those fitness days, drop a comment. I want to hear from you. Okay. That'd be really interesting if I got some OG subscribers on the live stream right now, but that was literally 10 years ago. But P90X, all that kind of stuff, that's an MLM from Beachbody. Okay. And here's the deal with MLMs. They are tricky because it is a passive income stream. And I would be lying to you if I told you that I wasn't making a passive income stream with Beachbody right now. I don't do anything with it. I'm going to be honest with you. I don't do anything with it anymore. I'm not secretly reaching out to people. I'm not secretly doing, in fact, I hate reaching out to people. It's not my jam. I don't like doing that. But I used YouTube to find people, to connect with them, to help them, and then to get, conversions on sales and things like that. But today, I don't do anything with it, and I do still make passive income. So yes, I've done it. It's not a lot of money. I'm not going to lie to you. Maybe anywhere from $500 to $1,000 a month. A lot of people might say, "Oh my God, that's a lot. $1,000 a month doing nothing." Yeah, that's pretty cool. But hold on, you got to hear this part. It sucked. I had to do so much work in the beginning. Didn't know what I was doing. Failed left and right. Spent so many hours just trucking away at trying to figure out how to build this MLM. So I know that's going to sound negative, but I would say that if you're going to do something like that, just know that it's going to be the school of hard knocks. You're going to have to go through a lot of learning and a lot of preparation and planning. Some people tend to be luckier, in my opinion, than others with these things. But just know that there's a lot of hard work with that, with MLMs, and be careful you don't get caught in the trap of spending all your money. A lot of times they're like, oh, there's this new product coming out that you got to try. It costs $100, or oh, there's this. You got to spend money for this. And before you know it, you look at your personal profit and loss, and all of a sudden you realize I'm spending more money than I'm making money. And they keep telling me, oh, but if you do this, you'll make more. No, because I am spending more money than I'm making. This is not worth it. So just be careful of that trap. I wouldn't say it's a no-go. Just it comes with a lot more of strappy things, in my opinion. Whereas, if you find other types of passive income opportunities, it could potentially provide you with a little bit less that you had to pay out just to be a part of something. It's just my opinion. Okay, hold on. Getting a lot of comments here. Let me check. Oh, I got some. Hey, Brian, thank you. You subscribed during the Beachbody days. I love it. And by the way, I didn't actually address that. The reason I pivoted away from that is, I wasn't as passionate. I mean, I'm passionate about fitness. I still work out. I still do Beachbody on demand. In fact, out in my garage every day, I do, and I still do Body Beast and Insanity Max 30. Those are my two most favorite workouts, and I do them just consistently and religiously, and that's what helps me, especially when I'm enjoying this Rogue Pumpkin Patch Ale, to not put on too much weight. But I will say that I wasn't, it was weird to me to keep using YouTube as a form of just advertisement on that stuff. It just didn't make sense to me. And I just had this burning desire to help people with their personal finance. And I tried it out in early, was it 2019 or something like that? I did some finance videos on my fitness channel, which was originally this one, and it went well. And I'm like, you know what? I'm going to do it. And literally almost a year ago today, I fully just pivoted this channel. And I will be honest, there are a lot of videos I'm starting to take down. So make sure if you want to check that stuff out, watch it while it lasts, because it's soon going to go away. I'm slowly not deleting, but I'm unlisting a lot of those videos because they don't make sense. You come here for finance, and I don't want YouTube recommending a bunch of fitness stuff. It doesn't make sense anymore. So anyway, have you bought Beachbody Stock Body? Yes. Not financial advice, but I have. And here's why. When you put it, and this one's hard. So we just talked about the 10 smart steps on analyzing a stock. If you go to do that on Beachbody, you're gonna have a hard time because they don't have enough financials yet. But I did look at their initial financials, and what they show is they have a significant amount of cash on hand, and they're a completely debt-free company. They have a like this new bike thing coming out and a bunch of other things. So I'm like, you know what? They're cheap right now. Let's see what happens. I might lose all my money. Well, I didn't put all my money into it. Don't invest things that you can't lose. I don't care if I lose this money, but I put a lot of money into it, and it'll be interesting if it goes up. If it goes up, I'm happy. If it crashes like Circuit City, it sucks. But again, it's not money. Never put money in that you need for next month's bills. But yeah, I did decide to do that. That's not my largest holding, nor will it ever will be. But whatever. Okay. There's a lot. Again, if I miss any of your comments, don't worry. I'm gonna look back through everything, and I will make videos in the future on some of these things, because I think there's a lot of cool topics that are coming through here. Sergio, you have a question? By the way, hey, it's going great. Oh, here we go. I'm still learning about Roth IRA. So my question is this. For example, the ETF SPHD has an expense ratio of 0.3. If I were to buy these in a Roth IRA, do we still pay those expenses? Yes, you do. Remember, you don't pay. So expense ratios are a little bit weird. What they do is they take that out of your net account value. So your value of that particular ETF will go down, but you don't see it. You don't actually have to pay it. Like, they don't send you a bill or anything like that, or there's no type of thing where you actually got to put your money into that or pay for it. It's taken out of your value, essentially. So yes, you still do have to pay any type of expense ratio on that. And the nice thing about the Roth, though, keep in mind that grows tax-free. So as a SPHD keeps going up, hopefully it does, right? And it pays dividends, all of that stuff, as long as it stays in the Roth IRA and gets reinvested, becomes tax-free. That's what I love about the Roth. and somebody mentioned it earlier too. That's why I'm so big on first get your match going in your 401k, but then max out the Roth. Anywhere from like $1 that you can put in per year, all the way up to the maximum of $6,000 per year. That's what you got to do. Max out the Roth, because it's basically taking your after-tax income, and then you put it in there, and then it grows tax-free. And that's the beauty of it. Let's say you have, like, someday an insane amount of growth on your holdings, on your portfolio holdings. You don't want to pay taxes on that crap. No, we don't want that. So the beauty of the Roth is you don't have to worry about that, because you technically paid taxes today to avoid taxes tomorrow. That's what I love about it. All right. I will make a video about my favorite REITs. Absolutely. REITs are fun because, they come with a lot of tax weirdness. I will tell you that, especially if you don't hold them in a tax advantage account, but they can be a lot of fun. I think I have one more question here I didn't answer. So hold on, let me get to it. I just kind of answered this question, but I'll pull it up because I want to give a shout out. Here we go. Hold on. I'll show you the whole screen again. All right. Connor, I'm 22, just graduated college. What are your tips for saving for retirement while paying off student loan debt? Oh, I didn't answer that part. Okay. I currently use my employer's 401k match. Spot on. That's awesome. But I feel like I'm missing out on the benefits of a Roth IRA. Any tips? Okay. So yeah, this stinks because technically you get the debt, and I get it. I was there too. But you've met one of the steps. And as I get into this whole thing, maybe it's Instagram Live, or it's a mix of Instagram Live with this YouTube Live or something like that, and we start answering questions in that Dave Ramsey format, I'm going to address some of these things. But I have my own little method and methodology to all this. First step is getting that match going on. And you do. You have the 401k match, spot on. That's perfect. That's exactly what you want to do. But then the next thing is pay off that dang debt. I don't know how much it is. You didn't put that in here, and that's perfectly fine. You shouldn't, you don't have to share all that stuff. But let's say, I don't know, it's $20,000, $30,000, $40,000 of student loan debt. Okay. You got to pay that off and make that a priority. So only do the match on a 401k, go crazy on the student loan debt, and then worry about Roth IRA. Trust me, I get it. It is painful to hear that, because you don't want to, it feels like you're missing a train that's taken off with that Roth IRA. And you're like, oh man, if I let another year go by, I'm missing out on that growth. But here's the deal with student loan debt. There's two issues with that. First, it stinks. Well, maybe there's three things. First, it stinks. Second, depending on the interest rate, it can just eat away at like your wealth, which stinks, especially if it's higher than 10% or something insane. But then the third and most important part that comes with student loan debt is typically they are not bankruptable at all. So I don't want any of you guys to ever get bankrupt. But if you do, and you got to declare bankruptcy, you can get rid of some debt, but those student loan debts are the worst, because they typically will not be forgiven, in the bankruptcy court. So those things will stick with you. You're going to be like, okay, cool, I got that all cleared away. Oh crap, I still got the student loan debt I got to pay off. So that's a headache. And I would recommend kick butt and take names on that. Side hustle, go crazy, try to make as much income as you can to just throw at that stupid debt. Get angry at it. I mean, I'm getting angry for you right now. I'm about to drop a lot of F-bombs here on YouTube, which would not be a good idea, because I just hate freaking debt like that so much. But the beauty is you're only 22. That's what's cool. Kill the heck out of this dang thing, and then you'll be rocking and rolling. And then max out your Roth IRA as much as you can. If you can afford the $6,000 a year or whatever it is by the time that you start investing, go all in. Go all in on that and build it up. So thank you for that awesome question. Let's see here. What we got? Can you go over backdoor Roth deposits? Hey, I'm going to do a backdoor video on Roth shortly, so stay tuned for that. I got you covered. That's a big topic. Definitely a cool way to really scale up too. It's awesome. Let's see. I am 30. And I decided not to contribute to my 401k. The reason is because I want to retire at 40 and use that money instead of waiting until 65. Okay, so that's a good point. So if we're talking about financial independence, especially those that do the financial independence retire early movement, that's important, because what you would have to do is really kind of focus on, okay, so I need money now. And typically you have to wait to the age of 59 and a half or something of that nature to start withdrawing on your retirement. It's perfectly fine to do. What a lot of people in the FIRE community do is that they do invest into their retirement accounts, but then they equally invest in the brokerage. Now, of course, that means you've got a lot of money to be able to do both of those avenues, or maybe you do a certain percentage split, like 10%, and the rest over here into a brokerage account, something like that. But then that gives you an option that, let's say you retire at the age of 40, you then live off of the income that you have in your taxable brokerage account from the age of 40 all the way up to 59. And then once you get to that retirement age, this whole other wealth of money that you've had stocked away in your 401k or your Roth then becomes available to you. And that's kind of a cool way to look at it. But either way, it's all based on what works best for you. So let me just make sure everything's rocking and rolling here. Okay. Cool. All right. Let's see here. What else we got going on here? So I started using surveys and Get Upside app, and I'm investing all my profits. Okay. Which surveys? Is it surveys in the Upside app? No, I haven't tried Get Upside. I've talked about inbox dollars. I think they're cool. As long as it's not one of those spammy ones. There's some survey sites that, man, it's like you got to go through all of this, and then they'll pay you like a penny. And in the meantime, they have a bunch of ads thrown on there too, and it just drives you up a wall. So those I try to avoid. But if it's legit, then for sure. I bought 250 of MO today. All that money came from picking up change on the ground and recycling in aluminum cans. Oh, that's so cool. I invest money from other people's. Oh, that's epic. That's an epic freaking side hustle. And I think you're talking about something like this, right? We were talking about this earlier. I got my pumpkin patch ale from Rogue Brewing going on here. And as I look at it, in certain states, it gives you that refund. Are you talking about that? Like you're taking this and you're saying, okay, I'll get 10 cents from this, this, and this. You just go pillage a bunch of trash. You basically are taking all this. And honestly, that's the scale up matter, right? You have tons of this stuff. You end up making a good amount of money. That's pretty awesome. I love that. All right. So international ETFs. Yeah, I got to, international is good. You got to decide what your split is going to be. Again, I can't give direct financial advice if I don't know all your situations, but I will say that it's good to have that balance, that diversification. You could get something like a total stock market ETF and then an international ETF and then some bonds. Just kind of match it up. Not going crazy into the bond world, but like maybe 10% there, maybe a couple percentages, maybe 20% into international, and then the rest into a growth stock. Perfectly something to be interested in, and also helps as things domestically are getting weird. It's nice to have that international, especially in the smaller growth sectors of the international markets. Get Upside is a gas app, and whoever you send your link to gets a profit. I get about 30 cents per gallon. Oh, okay. All right, cool. I got to check that one out. Thank you for recommending that. Not a good idea to invest money you'll need for a house. Did I miss a comment about that? Yes, got the refund from the can. I take them every week on the way to work. Oh, that's so cool. What an awesome, epic idea. I like that. Hats off to you. I love that. I love that. I don't think Florida offers this. I think it's everywhere but Florida. Darn it. Still a cool idea. I love that. I love that. Let's see. Maxing out my Roth IRA. I also have a Roth 401k. Awesome. My goal is to retire before 59 and a half. Should I increase my Roth? Check on this because off the top of my head, I always got to look this up. There is an opportunity in Roth to withdraw earlier than 59 and a half as long as it's been in there for 5 years and you've only taken out your contribution. If I said that right, check it out. But there is a way to do that before 59 and a half in the Roth IRA perspective. So that is something to definitely look at. Especially if you're retiring before 59 and a half. I'm a big fan of Roth 401k, especially if your company offers that. That's huge. Obviously, you got two different things, right? You got the 401k, the typical 401k. And a lot of times if you look in your paycheck, if you are contributing, which hopefully you are on a match, it will say pre-tax or before taxes. And that's what they're doing. That's the benefit of the 401k. You get to avoid taxes now, reduces your taxable income for this year. But in the future, on that 401k, they're going to tax you. So what you're doing is you're giving up tax today, but you're going to get taxed in the future. Roth is the complete opposite. Roth, it's going to be after tax. So basically your paycheck, your net income on that paycheck will then, the Roth 401k will then take that out of that net income and you'll be paying taxes today. But in the future, you don't have to pay any taxes. That's the difference between a 401k versus a Roth 401k. But in your paycheck, you're going to notice a difference, especially if you have both options. Let's say you have a 401k and you decide you're investing in that. You kind of get used to if you're paid on a regular, let's say you're like you make a salary and you have a very expected income. Every time you get your paycheck, you know kind of roughly what you're going to make. Well, if all of a sudden something weird happens, and well, not all of a sudden, let's say all of a sudden you decide you're going to move to a Roth 401k, you got to remember that income that you expected is going to go down. Why is it going down? Because you have to then pay that after taxes. You're investing that after the taxes. Hopefully that made sense. But yeah, so anyway, Amazon offers a Roth 401k and they are hiring. Amazon, that is awesome. That is awesome. Very good. Do you have any investments or thoughts on crypto? Crypto is an interesting market. Yes, I use Coinbase on a lot of this stuff because I like the fact that you can not only invest, but you can own the actual cryptocurrency. So if someday you decide you want to use it out for goods and services, let's say you're going around to the gas station and the gas station all of a sudden has a sticker on it that says, "We now accept Bitcoin." Well, if you had the ability to pay in Bitcoin with something like a Coinbase, you can do that. Whereas some of these brokerages, you're just investing in the crypto. You can't actually use the crypto. It's your own personal preference, whatever works better for you. That's something I personally like. Now, I will be honest, I don't go crazy on crypto because, I kind of go crazy more on the long-term growth investments. That's kind of who I am. That's what I do. But with Bitcoin and things like that, I think there's certainly some opportunity as long as the government stays away from it. Because I shared that article a little bit earlier on, and the government's starting, like the SEC is getting weird on us, so we got to keep an eye on stuff like that. So as long as that stays away from us, and then number two, as long as there's still enough interest where people and businesses and places like that start allowing the opportunity for payments for goods and services, I think that could be really huge. And I think with those type of things and with enough interest, sure, Bitcoin could hit 100K. I don't know about this year personally. I really don't know. It really depends how much is I don't want to say hyped, but sometimes it could be a hype. But it could also be the adoption. I think that's the better term. The adoption of this kind of stuff for future payment opportunities. Oh, wow. So Amazon just announced they're paying 100% tuition for a bachelor degree for current and new employer. Hey, if you are looking for a job, I am going to say, wow, with those two notes from the never ending highway, we got Amazon offering a Roth 401k. And I would assume they got they had to have some type of match. I would assume they got a match. I don't know what the percentage is, but they're matching your 401k. That's a Roth. And they're going to offer you 100% tuition for a bachelor degree, which means no student loan debt. Well done. Well done, Amazon. That's awesome. So if you're looking for a job, that's some very good benefits. Has anybody been involved this year in what we're calling the Great Resignation? Did a video on that because it's 6% match. Sorry, that came in. Wow. A 6% match is really good. I mean, typically we see about 5% or 3%. A lot of companies do 3% actually on average, if I recall that correctly. So 6% is above that average. That's awesome. But have anybody been involved in the Great Resignation? Have you decided to quit your job? Did a video on that a couple of weeks ago where we had 4.1 million Americans quit their job in April, and that followed up with another couple million in June and July. And I haven't looked at the statistics yet for August. I don't know if they're out yet or not. But how freaking awesome is that? Because it just shows that people are just done with the shenanigans. They want something new. And it could be the pandemic, right? Hopefully it wasn't anything bad. By all means, if you encountered something where, let's say you were laid off and then you were maybe underemployed, so you quit your job because maybe your actual place of employment got a new job back, that's a different story. But I'm talking about the people that are fed up with the BS and they're moving on. Has anybody actually been involved in that? Have you decided to take a change in your life to maybe scale up to the next new job opportunity, to maybe take, your opportunity from maybe you were making X amount of money, but now you found an opportunity to make more money? Or are you now working remote from home and you love that idea better than going into the office all day, Oh man, Matthew, thank you for your service being in healthcare. We are burned out. I can imagine. That's got to be tough. Thank you so much. You don't get enough thanks, and me saying thanks on this video isn't enough. So seriously, like serious business, I can imagine the burnout. Wow. No, but it would be great. I understand that. Yeah, it's kind of like, I think a lot of people, some of us got trapped up in the world of being at home, where a lot of jobs and companies and everything shut down. The world shut down, right? March 2020 to who knows how long after that. Some people went back in June. Some people didn't go back until January 2021. And it made people think like, hey, either I'm tired of being trapped up and I need to go back to the office, right? I'm tired of being at home. Or, hey, I really enjoy this. I love this freedom of being at home. I like the idea of being able to go, maybe walk my kids to school if you got kids, or hang out with my friends, or have that flexibility and freedom of not having to be stuck at a job, stuck at an office, So a lot of people have been moving around, and hopefully it's for the better. Hopefully it's for a better opportunity that you can continue to scale up your income and really make an awesome career for yourself. So yeah, let me make sure I didn't have any last comments here on this other thing, because I don't want to miss anything. Let's see. Okay. How's everybody feeling tonight? And also keep dropping any type of ideas that you may have. about future videos. I want as many ideas because look, I do a lot of research. I do a lot of things of what's going on, but nothing beats getting true recommendations from you guys because I want to do what you guys want to hear about. I mentioned earlier in the live stream, if you weren't with us from the beginning, where I'm looking to do like a question and answer type of live stream type of thing where you call in or we do an Instagram live or something. We do something where you ask your questions live and I answer you live, or you ask a question in a recorded format, like you dial into a phone number, you ask that question, and then what we do is I answer it in a future video, and I dedicate that video to you and your question, and we do that live. So I want to do stuff like that because there's nothing like hearing from you guys and answering what you are looking for. So drop those suggestions in the comments so we can make sure that we're addressing them in the future. Let's see here. I have another one, so I want to make sure I hit all of these questions that everybody had. So bear with me. I would hate to miss one and then they're like, "Hey, yo, I dropped something you didn't." Some people are talking about AT&T stock. AT&T just announced that they're going to cut their dividend yield and that they're selling out of Warner Media. Not just announced. That was a couple months ago. I did a video on it. But that's the whole thing about chasing the dividend yield that I mentioned earlier. You got to be careful about just chasing dividend yields. Like, oh, man, that's a 7% or a 12%. You got to do some background research on that. And you know, AT&T got people a little bit scared, right? The news, if you look at the 10 smart steps, the news on that, selling off Warner Media and HBO and all those type of things and only focusing on telecommunications, only focusing on phone service could be dangerous for AT&T. We're about to find out. I'll tell you what I'm doing. I'm going to keep a close eye on those guys. I'm interested to see what happens with their financials in the future and see what they do to maintain that business. Is it going to continue to scale up or is it going to fall down? If it falls down, they're going to have a rough future ahead of them, especially when they have competitors like Verizon Wireless, and then you got T-Mobile, and then even Google Fi. There's a lot of different companies that are going to push. And now that they don't have that portfolio of different type of brands like they did with Warner Media, it could either go great for them or it could go extremely wrong for them. All right. Let's see. Yeah, thank you so much. I appreciate that. Do you follow any other financial YouTubers like Graham Stephan? Yes. And in fact, I was one of the OG subscribers to Graham. Right around, what was it, like 2016 or something that he started? And I was still doing my fitness videos back then, and I found him because, again, I've always been passionate about personal finance, and I found him, and, you know, I'm like, oh, this guy talks about real estate, and that's cool, and I just kind of followed him, and here he is at 3.2 million. So yes, I follow him for sure. There's a lot of cool YouTubers out there for sure that do personal finance. And if you're a personal finance YouTuber watching this channel right now on the live stream or afterwards, drop a comment. Let's give you a shout out. Let everybody know that you're in personal finance and you got some videos on your channel. I'll do some free promos for you because, you know, I think it's cool. And everybody has a different perspective. It's just in competition. So if somebody's out there and they got something going on that's really cool that they can share with the world, hey, let's talk about it. You know, somebody might have a really cool idea. So Graham has phenomenal ideas. He's obviously one of the top tiers when it comes down to these YouTubers. And then you got Andre, you know, not only the cool magic, but you got the finances going on. Super awesome. Our Rich Journey, I follow them for the personal, the financial independence. Man, who else? There's so many of them because there's just so much. Like, seriously, you could watch like all these different personal finance YouTubers and really gain knowledge out of each one of them because they all have a little bit of a different perspective, right? And the cool thing about that is you take that knowledge and then you apply it for what works best for you. And then you become your future millionaire. So yeah, for sure. You know, who do you guys follow? Do you guys follow people like, I mean, Graham is popular. I'd be surprised if a lot of you didn't hear of him before. I'd be interested if one of you drops a comment and be like, who's Graham? Who's Graham? Maybe one of you on here don't know who that is, but Graham is quite popular. 3.2 million subscribers, you know? So I'm looking down here because I want to make sure I didn't miss any of these comments from the earlier questions I got. Oh, okay. Somebody said you talked about your 10 smart steps to pick a stock. Your 5 smart steps for picking up an ETF. What's your protocol for selling and holding? During the March 2020 lockdowns, my portfolio took a big hit. Okay, so I would not sell during the March 2020 lockdowns. God, I hope that never happens again. But if we have another market correction, market dip, or market crash, I'm not going to ghost you guys on YouTube. I will be here I'll probably do live streams every day if the market crashes again to that extreme, because the most important thing, there's two key principles here. One, never put in money that you're afraid to lose. So if you're like, oh, unless you're like, somebody mentioned about the house, don't put money in the market if you're about to buy a house, because if the market does decide tomorrow, hey, there's some news out, now I'm going to decide to do a market correction and drop by 10%, you don't be like, oh crap, I was going to buy the house next week, that was my down payment, and I just lost 10% of my money. You don't want that. So don't do that. But that's a key principle. Don't put in money that you need immediately, or don't put in money that you're not afraid to lose. The goal is the stock market over the long history trend has grown at an average rate of 8 to 10% every year. But there has been years that it stunk it up, right? All the way back to 1929 with the Great Depression. But you buy on those dips, never sell. Because if you're selling, that to me means that you're freaking out because you think you needed the money, and that's the worst trap to be in. So always follow that principle number one: never put money in that you're not afraid to lose. If you're worried about losing that money, don't put it into the stock market. What you want to do is, it's depressing to go. Let's say you put in $100 and it drops down to $50. That's painful to look at. There's nothing like pulling up your brokerage and being like, oh my God. But that's the time to start buying more. Have cash on hand, find a way to make more money, find a way to side hustle, find a way to do something, which is why it's so important to keep your expenses and your debt extremely low, because you want to be able to take that cash and then buy on the dip like a mad person. You want to go crazy on buying the dip when those type of things happen. During the March 2020 lockdowns, I went completely crazy on buying cruise lines and Delta Airlines and all those type of travel and hospitality businesses that took a nosedive because they were some of the first to be shut down. And I'm like, there's no way in heck that they're not going to come back, right? And then, beyond that, my more stable, ETFs and growth, I buy into that when they're on sale. So you got our Rich Journey also talks about this a lot, VTSAX. That's a mutual fund from Vanguard that tracks the entire stock market index, just like the ETF VTI. It's the same thing. So you buy into something that tracks the whole market. You never really sell that until you need to. That's kind of like that retirement fund, right? You're going to keep that in there until you retire early and live off of something like that. So you're not going to sell on the dip. What you're going to do is say, oh, cool, what I own is now on a discount, so I'm going to buy more. I'm going to add more to my account. And then you just go crazy on that. So that's what I do when it comes down to my protocol for selling. I would not sell unless there's a reason to, from the standpoint of, okay, I need to, live off of that at that point. Because, and Warren Buffett says it best, when you buy into something, you got to buy into it like it's your business. You're going to be a part owner in that business now. You want that business to be successful. So if you're going to marry up to a company that you think is a bunch of garbage and you're just hoping that the stock price goes up, that's scary because you're not looking under the hood. I always talk about looking under the hood of the car. If you're going to buy into something like I did back in the day with the Circuit City, I didn't look under the hood and I didn't realize the whole thing was falling apart, even though I thought it looked cool. And the thing left me with absolutely nothing but a junk bond or a junk stock, right? That I had to call Schwab and say, hey, listen, this thing's not worth anything. Can you just remove it from my account? How stupid is that, right? I didn't do my research. So yeah, I don't sell. I really don't sell. I hold on and I enjoy the ride. And if the stock market decides to be in a mood and drop, I'm going to buy some more. I'm going to buy on that dip. Oh yeah, I am on social media like Instagram and Twitter. Here, I'm gonna drop my Sweet Life Coach Instagram is I think what my Instagram is, and then at Sweet Life. Hold on, I gotta figure out what I should know this, right? Shouldn't I know what my own handles are? Hold on, gotta find out what my Twitter is. I don't have a lot of people on Twitter yet, so definitely join me on that. It's actually Sweet Life Money on Twitter. Go follow me on there. And guys, I'm also I haven't done much with this yet, but I'm trying a TikTok. Okay. If you're not on TikTok, you don't need to be, but I am at Sweet Life Money on TikTok. I have a stunning amount of followers on TikTok. You ready for this? I have a total of, get ready, 34 followers. Get in on the ground floor. Go find me on TikTok if you got a TikTok account at Sweet Life Money. I do not have a lot of videos on there yet because I'm still, YouTube's my jam. I'm still working on TikTok, but I do have plans to scale that up. So if you want some quick hits on TikTok, feel free to be one of the first followers on there. And then maybe once we hit 50,000 over on TikTok, we'll do a live stream on TikTok and you can be like, yo, I followed you when you only had 34 people. So that's what's going on over there. Yeah, buy on the 2020 lockdown. So cool. I mean, that was it sucked. I mean, I'm not saying it was cool that we were on lockdown. I'm saying it was such a good opportunity for the stock market to buy. The good old Warren Buffett, again, I'm going to quote him second time tonight, saying that, be fearful when people are greedy, and then be greedy when people are fearful. Wait, didn't I say that twice? Man, I've had too much of this. Hold on, let me say it the right way. Be greedy when people are fearful. Be fearful when people are greedy. I think I said that right. Yeah. Anyway, the beer's getting to me, guys. Anyway, and that's so important. So when people were fearful, that was the time to be greedy. People were fearful back in March 2020. People were fearful back in 2009 during the financial collapse, and people went all in on that. And I think that's so important to always have your finances in order, because if your finances are in order, when those type of things happen, you can go all in on buying those things on a discount. And then you get these things on a discount and then you ride the wave all the way up. Guys, I'm up 100 and something% on some of these cruise line stocks. And it's because I bought them when everybody was scared of them. Everybody was selling out of them and freaking out about cruise line stocks. I'm like, now's the time. Now's the time. I'm not going to let this pass me by like it did in 2009. I'm going to do it this time. I'm going to go all in. Same thing with some of my long-term investments, all freaking in. And then when people are greedy, be a little bit fearful. You might be like, hey, what about now? What are people greedy or are they fearful? What do you guys think? Drop a comment. Are people fearful or are they greedy right now in the stock market? I can't wait to see what you guys think. It's going to be a very interesting conversation. What's the ABV of this beer? Hold on. This is only, this is 6.1%. Hey, that's pretty good. But what is the standard? Like 4.5 typically? So not bad. All right, got my first comment, greedy. Brian says people are being greedy right now. What do you guys think? Are people being fearful in the stock market right now, or are they being greedy in the stock market right now? Because I think that's going to be a very important piece to what I'm about to share with you. Yeah, this is definitely above average. This is 6.1%. I didn't realize that. Oh, well. That's what's fun about the YouTube job. You can drink on the job. You can hang out here. We're having a good time. Fearful because of Delta variant. Oh, good point. Okay. Matt says greedy. Jim says more greedy, I think, right now. All right. No says both. Okay. Yeah, I guess it kind of depends on it could also depend on the sector, right? So we're talking about the Delta variant, and that could be based on where people are funneling their money, right? And people could be fearful about the fact that maybe travel isn't picking up because, now we got this other variant, and now people aren't going to travel via airlines, cruise lines, things like that. Good point. I will say the one thing I'm worried about is greedy from the standpoint of how high the market has got. Let me pull something up. Again, none of this is financial advice. I always got to say that because I don't want somebody to go out there and be like, hey, you told me this. I don't know your personal financial situation. I can never give that kind of advice because I don't know what you got going on. So do your own research and make your own decisions, right? But here we go. Okay, look. We're at an all-time high. You see this? So here's the fear right here. I don't know if I can zoom in. Can I zoom in on that? There we go. See this fear right here going on? This is the March 2020 lockdowns. Everything dropped. Oh my God. And now we're way up here. And that's cool. Now, could it keep going up? Of course it could. Could it have a correction? I'm not talking about a crash where it drops down like way down here, but it may go down a little bit. And we can see that if you really zoom into some of these things, like look back here, a little bit of correction here back in 2015, a little bit of a correction here in 2016. Things happen, right? The market goes up and down. Look what happened right here in 2018. You got this high August 24th, and then it drops down. This is the S&P 500. Look at that, January 2019. That's a correction. People might have freaked out right here. And let's say you held some companies in the S&P 500 and you're like, oh my gosh, I lost money. I invested on this day, August 24th, and I lost money. Should I just cut my losses and sell? That's like the curse word of the finance industry or the finance world is when you say, should I cut my losses and sell on a loss? Why would you do that? That means that you didn't have the money to do this in the first place, because look at that. So let's do a little bit of a fun game here. I think I can do it this way, right? Yeah, look. So you lost 11.92% from August 24th, 2018 to January 4th, 2019. And you're down on your luck. You think the stock market is a scam. This is your first time you ever invested. And I could understand why you feel that way, because that kind of stinks, 11.92%. But if you would have said, but I don't care, I'm going to buy the dip, I'm just going to ride it out. Now look. That next year, you're up 17%. Okay, that's exciting. The lockdown happens, you drop a lot of money, and you're like, oh God. But now look at where you're at. You're up 56% on your money from August 24, 2018 to September 9th, 2021. I mean, dang, that's pretty cool. So, that's the key is don't just settle, here's the financial collapse, right? If you did that, you're sad because you lost 42% of your money. But again, it's about the long game. And here you're up 36% on your money. Sure, it took quite a long time, almost 10 years to recover that. But even up to today, if you held on that whole period of time, if you invested back in March 2008, right now you're up 237% on your money. So don't let that jack you up. Don't do that whole, I'm going to cut my losses and just sell. Oh no, my screen's blurry. I'm sorry. I don't know if it's you or if it may not be. If it is everybody, I'm sorry that the screen's blurry. That stinks. Okay, BT said, should I take money from my 457 to pay off credit cards? 457. Isn't that a college account? 457. Or is that a 457? Hold on. It's 6.1% getting to me, guys. Can't remember what a 457. Oh, that's a different type of retirement account, isn't it? I would never take out of your retirement accounts. If that's I think a 457 is a different type of sector retirement account. Is that for, anyway, if it's a retirement account, no, you don't want to do that because that would mess up because you get penalties for taking out money early. But one thing, civil service, thank you. Yeah, I'm like, wait, what is it? It's 529 is the college account. So 529 is what I thought. I saw 457. My mind went to 529. I'm sorry. Yeah, 457. Okay, so the thing is, you got to make sure that you don't get hit with any of those penalties when you take out your retirement accounts. This goes back to actually before all that, before you invest in the first place. It goes back to, and I got a future video coming on this, should I invest or should I pay off debt? And a lot of people ask that question because a lot of people think, hey, if you have a low interest rate, if you actually invest, technically you're making more money when you invest as opposed to, trying to take all your cash and apply it to the debt. Let's focus on investing first. But there are some cases that's a bad idea. There's some cases that's a good idea. And there's a lot of things to think about. So I will actually talk through that in a future video. I'm excited about that. If you guys aren't aware, I am working to pay down my mortgage. And a lot of people give me heat on that. And I totally get why you're doing it. Totally understand why you're doing it. Because my mortgage, let's say you have, I think we're at a 2.5. If you got a 2.5% interest rate and you're paying down a huge balance of a mortgage, why the heck would you do that? Because a mortgage, if you're putting all this extra principal toward it, sure, you may be getting a return of 2.5% on the interest rate. But if you put that into an investment, especially over the long period of time, you're going to make so much more money. What is wrong with you? And I understand why you're saying that. I'm not saying, you don't know what you're talking about. I get it. I agree. Here's my issue. I don't like the risk of it. And so that's where a lot of people got to think through what do I feel comfortable with? And if I don't like the risk of having that debt, having that mortgage, having that low interest debt, that could be a big deal. Because what you don't want to have happen is that Monday morning you go into your job and your boss sits you down and says, hey, listen, tough times, we're going to have to lay you off. And we have barely a severance package for you. So you're screwed. Have a good life. And you're like, oh my God. What do I do? And that sense of panic, why do you think you panic? Why do you think you fear when you get laid off? Because you're like, oh God, I'm not making money now. How am I going to pay my bills? And the housing costs are like some of the biggest expenses for everyday people. Your housing and electric lights and all that, but housing makes up most of your monthly expense. So my idea is, let me get rid of that expense, and then I can scale up and work however I want, whenever I want, and find different ways to scale up income without worrying about the risk of, if something falls apart, I don't have to worry about, not having enough money to pay off the thing that we live in and everything like that. So anyway, I got more videos coming on that particular thing. So I would just say that, when it comes down to credit cards, a lot of them run at a 14% interest rate. And if you got a lot of high interest debt on that, that would be more sensible to pay off the credit cards than invest that money. So as future money comes in, throw it at the debt, throw it at the credit cards and all that crap, and worry about investing once you get out of that. Because think about it, every time you pay down and you're getting rid of that interest rate, you're getting a better return, that return of 14% that you would be paying on that credit card interest, as opposed to putting it into the stock market and making maybe on average 10%. So you're saving yourself 4% by doing that. Hey, Brian, thank you so much. I appreciate it. And I will do another live stream before we get to 100. Share this. I want to get to 100,000 next month. That's a lofty goal. But anyway, okay, let's see what we got going on here. So do you look at delta when you sell cash secure puts and covered calls, or just strike prices? I do look at delta. I don't do a lot of options trading though. Even though we talked about QYLD and things like that, I don't necessarily go full board, but yes, I do look at delta and stuff like that. Oh, somebody asked me earlier, YouTubers, and I'll give a shout out to Brad Finn. He does a lot of options trading on his channel, a lot. I mean, that's kind of his primary premise right now, it looks like. So I'm going to give him a shout out. Go check that out. Specifically, he goes into delta and how to look at some of those things specifically. So definitely worth checking out. Let's get to 100,000. Share this. If we can get to 100,000 by next month, I will honestly, I will go crazy. We'll do a live stream with major giveaways. It's going to be completely out of control, because if I can gain 50K subscribers in 1 month, that's off the chain. But hold me to my word, man. We will have so much fun. We will give away all kinds of stuff. We're talking money, gift cards, shirts, you name it. It's going to be a good time. Yeah. Dividend stonks. Yeah, we're going to have some videos coming very soon. In fact, I have a question pending right now from a comment I got quite a while ago, and somebody was asking, what are the top 5 or 10 monthly paying dividend stocks, or what are the best dividend paying ETFs? And I'm going to go through those in an upcoming video, because that'll be a huge one for sure. And really, we want to dive into 2 different things with that. One, for those people that need dividend income, let's say you're going to live now off of dividends, right? How does that work? And then also, what does it look for those people that are still in the growth phase and want to continue to grow their portfolio, taking advantage of reinvesting the dividends? And that is something that scales up, because you have 2 things that happen. You have the growth of that stock or ETF, which is what you want. You want it to keep going up in value. And then you want to see some success on the dividends, right? So you see the dividends get reinvested, and then you have the growth at the same time. What does that look like in the future? And how do you find the best ones that'll give you that goal, for your future millionaire plus portfolio, right? That would be the game plan. So yeah, I love dividends. You got your different ways of investing for those dividends. You got your retirement tax advantaged accounts. You got your brokerage accounts. It's a lot of fun. And those people that there's a way that you can calculate how much you want to live off of based on, let's say you want to make $50,000 a year in dividends, right? Based on the dividend yield, the percentage of either the company, the REIT, the ETF, you could take that and then find out how much money do I have to invest in this portfolio in order to make that $50,000 a year. And what's really cool is that it kind of gives you a roadmap for what you need in the future. Now, it can be absurd. Let's be honest, especially if it's a low dividend yield. You're going to be looking at like a $1 million portfolio. You might fall over and say, well, how the heck am I getting to that? But remember, there's two things that work on your favor. One, you got the dividend snowball effect, because the goal is these companies continue to increase their dividend payout. That growth keeps going. At the same time, you have this goal of seeing growth in the portfolio itself. So you're contributing money. It grows at an average rate of 10% a year. At the same time, the dividend grows and continues to be reinvested while you contribute. So, it's not like you have to find a way to make $1 million and take that $1 million and shove it all into the stock market. That's not what we're talking about. It's just your portfolio, your investment in that percentage would need to be potentially $1 million in order to do that. And you're absolutely right. Retirees need dividends. Yes. And Stag is a good one. Stag is the one. I have that one. That one has Amazon warehouses and things like that from a REIT perspective. So yeah, that's a good one. But retirees, especially as you get out of the growth phase, you don't want, typically in a good world, you don't want those high volatile stocks. Now, retirees aren't going to sit there and say, I'm going to invest in AMC and GameStop, right? Because they're not going to take $1 million portfolio and pray to God that it keeps going to the moon. Because what happens if it drops down and then they're like, oh God, that's my retirement. They want something stable. Typically, you want to be able to put money in and have that, income coming in every single month. It's expected, it's typical, and just keep making money and living your best life in your golden years. And again, that doesn't mean that you're 65 years old. You could say, I'm going to retire at the age of 35 because I was smart from the age of 18 to the age of 35. Now I'm going to retire and live my life, but enjoy that golden life ahead of you from the age of 35 all the way up to 65 plus. That's pretty awesome. Imagine if you can get a monthly dividend payer inside your Roth that generates $500 a month. If you take into account $6,000 every year you contribute, now a total of $12,000 a year. Yeah, absolutely. That's the power of the dividend snowball and all the different, even the growth snowball that really kind of scales up. Super awesome. Super awesome. All right. So, wow, guys, it's 10 o'clock at night here on the East Coast. And again, here we are, 50,334 subscribers as of right now. 1 year ago, I was at 15,000. And that was basically all based on my fitness stuff, I think, So it's so cool. And if we can do this again, that means what? In the next couple of months, we'll be at, because I did a live stream back in April, and I think it was actually April 9th. And we were at 25,000. So if we can do this again, what is that, like February or something? We'll be at 75,000. So, but we were just talking about the fact, let's get to 100,000 next month. So how do we figure that out? Share this video and let's see what we can do. Let's get this up. And again, what I need from you guys is what you want. What do you want to see on this channel? I want to develop content that works best for you, because, together we're going to do what they never told us in high school. We're going to break the cycle of the hamster wheel of just like blindly going through life and then hoping to dear God that we figure it out by the time we need it. And sometimes it's too late. So if we get started today, and it doesn't matter if you're 20, 30, or 40 years old, the point is we're going to start today, we're going to stay consistent, and we're going to scale up. And as we continue to scale up, we're going to live our ultimate sweet life. And that's why it's right over there. Live your sweet life. Right there it is. That's the key point. The sweet life is what you desire. It's what, when you wake up every morning, you're like, oh man, life just kicks so much butt. I love it. Freaking, I can't wait. I can't wait to start the day. That's what the sweet life's all about. So anyway, guys, I'm going to get going here tonight. Thank you so much, guys. I appreciate the support, everything that you guys have done. And I can't wait for the next 50,000. I can't wait for the next couple of videos coming up. Again, comment if you have any other questions later on. If you want to see a future video, drop it down here. Follow me on TikTok, Instagram, Twitter, and all those other random things. And that way you can also get a hold of me, I think, a little bit easier. It's a little bit hard to get a hold of people within the good old YouTube. So definitely follow me over there and feel free to ping me anytime you want. So thanks again, guys. Have a great night. Here's to the next 50,000. Take care.